You have the following information for McHugh Inc. for the month ended October 31st, 2010. McHugh uses a periodic method for inventory. And you see on the screen we've got beginning inventory value, we've got 3 purchases and 3 sales that all took place during the month of October. And we've got the units as well as what the selling price was or the cost. And the cost relates to purchases and the selling price relates to sales. And then we're asked to calculate ending inventory, there's a typo there, cost of goods sold, gross profit, and gross profit rate under each of the following methods: LIFO, FIFO, average cost, and then compare results for the 3 cost flow assumptions. And when you use average cost, they've told us to round the cost per unit to 3 decimal places. Okay, well, the first thing we need to do is calculate the cost of goods available for sale. And cost of goods available for sale is going to be the same regardless of which cost assumption method we use, because cost of goods available sale is merely the accumulation of all the costs. So we start with beginning inventory and then we add the purchases. And you see on the bottom of this slide, what we're doing is multiplying the units times the unit cost to come up with the total cost for what I call that layer. And in this case, there are 4 layers: the beginning inventory and then the purchases on the 9th, the 17th, and the 25th. So every row is a layer, and when we add them all up, we come up with total cost of $9,370, and that represents the total cost for all 350 units. Now on this slide, we'll calculate ending inventory in units as well as sales revenue, and you see that on the bottom area of the slide. So on the bottom left, let's take a look at how we calculate ending inventory in units. On the last slide, we determined that the units available for sale were 350. And then we had sales on 3 days, the 11th, the 22nd, and the 29th. And the sales on those days were 100 units, 60 units, and 110 units. So we sold 270 of the 350 units we had available, which leaves us units remaining in ending inventory, and that's 80 units. Now to the right side, we look at sales revenue. Well, sales revenue occurred on the 11th, the 22nd, the 29th. The units were 100, 60, and 110. And then we multiply the unit price that was given in the problem times every sale we had. So on October 11th, we had 100 units that were sold at $35, so the total sales price is $3,500. On the 22nd, 60 units at a price of $40, so we've got $2,400 in sales. And then on the 29th, 110 units were sold at $40, so that's $4,400. When we add up all of the sales, we have a total sales of $10,300. Okay, next on this slide, we're going to calculate ending inventory, cost of goods sold, gross profit, and the gross profit rate, all under the LIFO cost flow assumption. First, let's tackle ending inventory. I think of LIFO and FIFO both as layering effects. In the case of LIFO, since the last one in is the first one out, when we calculate ending inventory, we start with the oldest layer and work our way towards the most recent layers. So the oldest layer is the beginning inventory amount, 60 units at a cost of $25. And then the next layer, and by the way, then we only have 60 units accounted for, so we have to keep going until we account for all the units we have in inventory, which was looks like 80 units. By the way, that screen's off a little bit. The 20 at $26 should line up directly under the 60 at $25. So on October 9th, we go to the second layer, which was 20 units. Now, even though the purchase on October 9th was 120 units, we determined in the last slide that the ending inventory amount is 80 units. So if we've already accounted for 60 units, then we can only accumulate as many units as we had on hand, physically on hand. So only 20 units get added there to give us a total of 80 units. And then we multiply each of those layers times the appropriate cost. So the $25 represented the unit cost as of October 1st, the beginning inventory, and the $26 represents the unit cost related to the October 9th purchase of 120 units. When we add that up, we come up with ending inventory for 80 units equal to $2,020. Now let's move over to the right and tackle cost of goods sold, and you see how this is calculated. We take the cost of goods available for sale, the $9,370 that we previously calculated, and we subtract the ending inventory that we just calculated, and that's how we can come up with cost of goods sold, $7,350. Well, $7,350 divided by sales revenue of $10,300, which we calculated on the last slide, gives us a gross profit amount of $2,950. And moving over to part 4, if we take the $2,950 and divide it by the net sales amount, we see that the gross profit rate is 28.6%. Okay, now we're going to solve the same questions that we just solved using LIFO method, only this time we'll use the FIFO method, which is first in, first out. Again, we use a layering approach, and since the first one in is the first one out, when you are determining ending inventory, you need to start with the most recent layer and work backwards. So on October 25th, we had a purchase of 80 units. Well, we only have 80 physical units in ending inventory, so that's our entire layer of ending inventory. Under FIFO, we assume all the other purchases in the beginning inventory were sold. 80 at $29 gives us ending inventory of $2,320. Cost of goods available for sale, we already calculated at $9,370. We subtract the ending inventory that we just determined using the FIFO inventory cost flow assumption, and we come up with cost of goods sold of $7,050. Then when we take $7,050 and subtract it from sales revenue, this is in part 3, we are able to calculate a gross profit of $3,250. And then in part 4, take the $3,250 divided by the sales revenue or net sales of $10,300, and we come up with a gross profit rate of 31.6%. Now we look at the weighted average cost per unit, or some people simply call this average cost. And average cost is not a layering. Every time we have a purchase under the periodic inventory system, we calculate a new average cost. So if you were to look back at our slide where we determined cost of goods available for sale, we calculated that the total cost was $9,370, and that'll be the same under any inventory system, any cost flow assumption you use, because that represents the real out-of-pocket dollars you spent for the inventory. So $9,370 and divided by the 350 units, which was beginning inventory plus all our purchases, that calculates to an average cost of $26.771. Well, with that average cost, we take the physical units on hand at the end and multiply it times that weighted average cost. So 80 units times 26.771, carried to 3 decimal places now, gets us to, in rounded dollars, $2,142. On part 2, we subtract that $2,142 from cost of goods available in order to determine cost of goods sold. And what you see is it's $7,228. Under gross profit, we subtract the $7,228 from the sales revenue of $10,300 to come up with gross profit dollars of $3,072. When we divide that by net sales, and net sales and sales revenue in this problem mean exactly the same thing because there are no sales returns or allowances. When we divide the $3,072 gross profit by the net sales of $10,300, we come up with a gross profit rate of 29.8%. The last part of this problem asks us to discuss what we've seen here. And what we've seen is that LIFO produces the lowest ending inventory value, the lowest gross profit, and the lowest gross profit rate because its cost of goods sold is higher than FIFO, or average cost. And hopefully this makes sense to you, because you see that during the period we had increasing prices. The beginning inventory was at a cost of 25. The purchase on the 9th was 26. On the 17th it was 27. And the purchase on the 25th was 29. And during a period when we have increasing prices, which for many items is the norm, you'll see that LIFO will result in the lowest gross profit and lowest net income. Or another way of saying that is it will result in the highest cost of goods sold. FIFO will act just the opposite. FIFO will get you the best income statement because it winds up showing you the lowest cost of goods sold, the highest gross profit, the highest net income, and the average cost will fall somewhere in the middle.